Yeah, please give me a green signal and then I'll begin. Okay.
Check Professor's audio and everything is fine. Professor, so everything
Yeah,
is fine.
you
Audio.
can. Yeah, you can hear me.
Yeah. We can hear
Okay,
you.
go
Yeah.
ahead.
Thank you, sir.
Yes, sir.
Uh, Darshan.
Yeah,
Uh,
we are live. We are live on YouTube.
okay.
Okay. So we're going live on 3, 2, 1. Good evening and welcome to World Investor Week 2020. On behalf of the Center for Capital Markets and Risk Management, IIM Bangalore, along with NSE and SEBI, I, Anvesha Sinha, welcome you all. Our speaker for today evening is Mr. Hari K, Chief Business Development Officer, National Stock Exchange. Mr. Hari spearheads business development for equities, derivatives, debt, and currencies for the exchange. He represents the exchange in various committees in SEBI and has been with it since 1995. He was involved in launching of derivatives in India and was heading listings at NSE for over 10 years. He was also involved in launching the NSE SME platform, Emerge, and has handled various profile businesses, operations, surveillance, clearing corporation, membership, corporate communications, to name a few. We welcome you, sir. The topic for today is listing on stock markets, a fundraising platform. The webinar will be followed by a Q&A session where the viewers can ask the respective questions. The chat window will be switched off throughout the webinar. Thank you, sir.
I can start.
Yes, sir. You can begin now, sir.
Thank you. Thank you for the kind introduction and good evening to all of you. Um, First of all, it's a great opportunity to partner with the IIM Bangalore and SEBI on this World Investor Week. So listing on the stock market is, on the stock exchange rather, is more related to fundraising. So what I'm going to quickly cover about is, why should somebody list on an exchange and what happens after that. So one of the there are two key participants in the stock exchange. One is the investors, who come through the trading members of the exchange, and other one is the issuers called the listed entities. So when you raise capital, and when you come to the market, one of the key responsibilities is that you're taking money from public, and there are a few responsibilities associated with listing, since you're responsible for the money which you have taken from public. So there is a formal a kind of a listing agreement which you enter into with the stock exchange, and there are some regulations which a company follows for getting listed. So why should somebody get listed? I think basically, in India, after Bollywood and cricket, I think, stock exchange is a key place for visibility, especially when the markets go up, and a lot of people keep talking about the index. Nifty is at 10,000, Nifty is at 15,000, Nifty is at 14,000, things like that. And now Bank Nifty is another index which has become as popular as Nifty. So coming to visibility, I think stock exchange is one of the places to be for visibility, and also as a listed entity you get a lot of credibility. Why you get credibility is that because you're listed, you have to follow some rules, regulations, norms of the exchange, and there is and a stock exchange is like a gatekeeper. Lot like everybody who wants to raise capital cannot come and get listed. There are some norms to be fulfilled, so you get better credibility. Another important element for listing is access to capital. It's the cost of accessing capital is very less. So typically, if somebody wants capital, they go to a bank, then they go to a PE or a VC, and then they go to public. So when you take this public route, the cost of raising capital is much lesser. So that will help you to, with lesser capital spent, that will help you to raise more money from the market. And another important element of listing is also it's a diverse, investor base. You get a retail participant, you get institutional participants. The institutional participants will include mutual funds and insurance companies. You also get access to foreign institutional participants, which includes the global, funds like the big funds of the world. And there are various kinds of investors who come into the market. India is a very unique market in that way. When you trade in our stock markets, you have the retail investors, you have the institutional investors who will be both domestic and foreign investors. Then you have the proprietary traders. A proprietary trader is a trader who trade only for himself. He doesn't have any clients. And the last one is the traders themselves. There are these guys who have the short term views. So this healthy mix of all these participants provide you the great liquidity in the markets. So when I say liquidity, what happens is that the when you want to buy and when you want to sell, you're able to immediately buy and immediately sell with a less difference between the buy price and the sell price. So liquidity is another important factor for listing in the markets. When you come to when you come, this is the participants in the market. But when you come and access the public as a listed company, you get access to investors. For you, all the investors are same. So there'll be some retail investor, there'll be some high net worth investors, and there'll be some institutional participants or anchor investors, as they call it. So these are the various participants in the market. And the another important reason for an Indian company to get listed also is for if you give you want to incentivize your employees and you give them ESOPs, the one of the better exit option for the ESOP is to come and sell it in the market. So these are some of the factors which really require somebody to get listed. So when we are doing business with somebody, and if you don't know the entity, be it domestic, be it international, we first go and ask this entity, hey, are you a listed entity? So what happens? Listing automatically gives you that credibility. So when we say credibility, there are some companies who use a kind of a rubber stamp on their letterhead itself, name, address, etc. On the side of the rubber stamp, there is a kind of a rubber stamp which saying listed on NSE, something like that, which gives them, when they write to somebody these days, letterheads are very not very common. So on your email, there is a caption when you give your header footer. They also say that you're listed entity. So that is on the listing front. But what comes along with listing, not only it's as I said, that it's easy to raise capital. So you prepare your draft red herring prospectus wherein you give all the details about the company. But once you get listed, there are some quarterly reports where you give to the exchange. For example, you have to tell public through the exchange your results, quarterly results. What are your corporate governance standards, your shareholding pattern? There are many requirements which come with the listing, which is put by the exchange in the public domain, which will allow investors to take informed decisions. Because when you talk about liquidity, there are buyers and sellers who are coming in. People who have already subscribed to an IPO have already taken the capital, and when they want to sell, there are somebody who wants to buy the shares. So when somebody wants to buy the shares, they take all the relevant information which is available in the public domain. So most of the information will be available on the website of the exchange, wherein we put as an announcement of the various announcements which a listed company gives it to us. So SEBI, our regulator, has given from time to time enhanced the disclosure requirements, enhanced the governance standards of listed company, which also improves and increases the credibility of the issuers listed on the exchange. So coming to a listing platform, typically we have our main board. Main board is an SE where you get listed um, with a specific capital. We also have an SME platform called the Emerge platform. Emerge platform, as the name indicates, is for emerging companies, wherein the SME, we don't go by the definition of SME per se. We go by the definition of the paid up capital of the company, the listed capital of the company. So the difference between the main board listing and an SME listing is not only on the size of the company in terms of capital. There are some relaxed entry norms, relaxed compliance in terms of frequency of compliances and stuff, half quarterly, you may have to give half yearly. Then you also get a chance to migrate to a main board after you fulfill some conditions. And then there is also a requirement of market making. So there are compulsory market makers appointed by the merchant bankers, who will the market makers will provide two-way codes, so that at any point of time, if you are invested in an SME company, you get an entry and exit option. So that is our SME platform. We'll come to the details slightly later. Then we also have a platform for innovators growth platform. It's mainly for the technology companies which are coming into the exchange. So these are the platforms which essentially caters to the market requirement. We also have a debt market wherein uh, we do private placement of debt and the public issue of debt. Public issue of debt securities get listed on the capital market segment of the exchange. The private placement of debt, it's mainly with few institutional investors, that's listed on the debt market segment of the exchange. But these are all jargons which I'm using, but to be simply put, they're all various fundraising options available for people, and various listing options available on the stock exchange. So if you see, even during the last say 8 months, in this unfortunate pandemic situation, we have seen decent issuances coming into the market. Companies have raised about 20,000 crores in this period as well. So, I mean, there used to be a time when, when a company gets listed, we used to have a listing ceremony wherein the promoters used to come and ring the bell. I know a month wherein all the working days in the month we were ringing the bell. That was the number of IPOs, more than 100 IPOs in that year. So it all depends on the market conditions. One is you want to raise capital. Second is the market conditions, which is very important. The market conditions will allow an issuer to come to the public and raise capital, depending on what is the time of the issue, where the market is, etc. Today, as we speak, our secondary market is almost at all-time highs, but primary market is, as we see the newspaper reports, they say December is going to be a lot of issues which is coming in the primary market, which is now gaining significant momentum. Even in the SME space, on a listed on the main board, I think we will have about 1750 companies listed on us. On the SMEs, we have over 200 companies listed. They have raised more than 3,200 crores on the SME platform. So on the SME platform, as NSE, we have been little watchful. We try and concentrate on companies which are more manufacturing oriented, not service oriented, so that the brick and mortar kind of companies get more opportunity to tap the market and get listed on the exchange. And as I said, over a period of time, they can get migrated to a main board, so that it's a stepping stone. They know what's compliance is all about. They know what's disclosure is all about. Because we always tell the SME promoter, you focus on doing what you're good at, that is manufacturing, and leave the compliance to a compliance officer who will be able to fulfill the requirements. Because once you start delivering your numbers, that gets automatically reflected in your results. But most of the IPOs, what we see in the Indian market, just like the other markets as well, is an exit for a PE or a VC investor. Because most of the time, the companies go to a VC or a PE, they get invested. When they want to exit, they will ask the company to get listed. So when you get listed, through a VC or a PE, it's called an offer for sale, and it will be an offer for sale combined with, a public offering as well. So if a company wants capital for expansion, that will be the public offering, wherein they give in the objects clause of the draft hearing prospectus, they are raising money for the purpose of X, Y, Z, and they keep telling the market over a period of time what money they have raised and how they have utilized. When we say an exit for a PE or a VC, we call it as an offer for sale, wherein we tell that the proceeds of the IPO goes to the PE who sold a stake in the company. So that is another type of an IPO, but it's all raising capital to raising capital to public. So the SEBI, I mean, even during the pandemic, SEBI has rolled out several measures to provide relaxation, one-time measures in terms of relaxations for compliance requirements, validity of observations of draft offer documents. Typically, when you raise capital, when you give an offer document to SEBI and it gets approved, it's valid for a particular time. In this trying condition, SEBI has extended the observation period for the draft offer documents of the company as well. And the minimum subscription amount in kinds of rights issue by companies. I mean, so variations from 20% to 50%, permission issue size variations from 20% to 50%. These are all some of the relaxations which the regulators have given over the last 6 months. Some are one time, some are still continuing, but that's basically because the whole industry and the economy is going through this trying conditions. So there are some measures which has been done. And India being a country which is far more electronically savvy, I think many of the issuers and many of the requirements have been able to companies have been able to fulfill, because work from home and other concepts have come in a big way. And and that's helped compliance help compliance in a big way. So when we talk about the markets, one is when you get listed, your equity comes and gets listed, right? So what the exchange does is that where the issuer has got no control over it, once your company gets listed, then the volumes, if a lot of people trade in your company and the volumes gets improved, automatically you're eligible for participating in the derivatives market. So India, being and NSE has got one of the largest derivatives market in the world, and we out of 1,750 companies, about 140 companies which are high in liquidity, high in volumes, get there are some fixed parameters for that. Once you fulfill the parameters, you get eligible for trading in the derivative segment. And so what happens if you trade in the derivative segment? Whatever corporate actions the company gives, rights, dividends, bonus, has got multiple effect on the derivatives platform as well. So they're very quite highly intertwined. And stocks and derivatives, typically the empirical data suggests, if a stock is in derivatives, the liquidity in the cash market for those stocks are much higher. So, on an average, these days, in the capital market, that is in the cash market, NSE's volume is about 60,000 crores on a daily basis, which is about 94% of the market. And on the derivative segment, we do volumes which are we are almost 99.9% of the volumes in India. And globally, I think we are one of the top three exchanges in the world in terms of number of trades in the cash market, and also in the derivatives market in terms of number of contracts. So these are all some of the milestones which we should, primarily because of the number of investors whom we have, number of issuers you have. We have got in the last 6-8 months itself, we've got more than 35 lakh new investors who have come into the market. When I say new investors, they are new PANs, first time they are trading in the market. So these new investors are from mostly from tier 2 and tier 3 cities. What typically happens, when you get more investors, the company, when they trade, when they start participating in the market, the liquidity in the market improves, and also as I said, issuer gets diverse set of investors in their investor base. So this will help to distribute the risk more efficiently. The company is not dependent on one class of people who want to come and sell the shares one day. It used to happen in India when FIIs want to, suddenly they sell the market, the whole market used to come down. But now our domestic market is so strong that even if there are huge inflows or outflows in from the FPI participants, the market does not move in either direction, because we have a strong domestic market to support this market as well. So from a very listing centric perspective, one is to raise capital and other is to get listed. The third, when you come to compliance for listing, that's where I think it's important for the companies to focus on compliance, because there are millions of new investors who come enter the company day in and day out, and people exit also. So when you have people coming in and going out, it's important they know all the information what everybody one should know. SEBI has made these guidelines more transparent. There are a couple of discussion papers also in public domain. For example, now there's a discussion paper which says that if a issuer is meeting an institution on a one-on-one basis, the transcripts of that should also be put in public domain. The idea of making all this transparent is that no specific person or specific group of persons should be privy to some information which others don't know. So the idea is the idea is that all information about the company, be it a company bagging a big order, or be it a fire in a factory, all this information has to be in public domain, because the market will dissect that information and see how that information can be reflected on the prices. So it's all culminating into the prices. Generally, when a stock is trading on the exchange, there are some price bands given. The price bands are typically decided by the exchange with SEBI and the surveillance teams, to say that stocks in a particular category have 10% price band, stock in a particular category have 20% price band, and stock which are in derivatives don't have price bands, because derivative stocks generally don't have price bands associated with that. So the price bands is another important factor, which the issuer doesn't have control over it. It's all managed by the exchange. So typically what the exchange does is, the exchange provides a platform for the buyers and sellers to meet and arrive at a price through demand and supply. We used to have a trading floor before, but now it's all electronic, so you don't have to worry about the liquidity. Name the stock, you'll have liquidity on the exchange. As I said, once you get listed in the cash market, then comes the derivatives market. We also have a market called a lending and borrowing mechanism. There are people who want to, say for example, you are an institutional investor. You're not going to sell the share for a long time. You're just keeping it for a longer time. It's just idle. If you want to earn some return on this, you can lend the shares to somebody who wants to borrow the shares. They will give you some fee for it. As a lender, you are eligible for all the corporate actions as well. You will also get a fee for giving the shares, say for 1 month or 2 months or something, and then you give it to some person. He will use the shares to for whatever he's got a need for, and then he gives it back to you. The whole transaction is guaranteed by the clearing corporation. It's a product of the exchange. It's called SLB, Securities Lending and Borrowing. So that's another product which has come out of the base product of listing on the cash market segment. So we have a cash market, we have a derivatives market, we have a lending and borrowing segment. As an exchange, we also have a currency market, we have a commodities market as well. And then so these are the markets available, but specific from a very issuer perspective, they focus on the cash market. They focus on, once you get listed, you enter into an agreement, you pay the annual listing fee to the exchange, which is minuscule compared to international standards, but you also comply with the exchange, the SEBI and exchange rules and regulations from time to time. We also talk to the issuers. We give them a compliance calendar. So once you fulfill the compliance, kind of a calendar, then you are almost sorted on what are the various do's and don'ts, and what are the various things you do from time to time. There are some subjective compliances. For example, if you're going to say you have to disclose some price sensitive information to the exchange, it is the management of the company who takes the call which is price sensitive and which is not price sensitive. So, but broadly there are guidelines to follow on the price sensitive information also. SEBI has also come out with the corporate governance norms. One of the norms is having shareholders and investors committee. Corporate governance yeah, also tells you about the composition of the board, composition of independent directors on the board, composition of women directors on the board. So these are all part of listing regulations, and and these governance and these submissions has to be made to the exchange every quarter. And as and when you make it, the exchange has also made this facility online. So every listed company does have a facility to log into our database and send these announcements from time to time, which automatically gets pushed to the website of the exchange, which the news channels and other info vendors pick it up and start displaying it to the market. So that's how this information becomes public, and that's based on this information, informed investors can trade or participate in the market based on the information available in public domain. So these are some of the base thoughts on listing on an exchange. What we see as a challenge in this is, especially in terms of listing from an SME perspective. Most of the SMEs, when we go and approach them, they're not ready for listing. They're ready for funds, but they're not ready for listing, basically because the books of accounts are not books of accounts are not maintained by them in a very structured manner, and so it takes some time for people to make the books of accounts in a structured manner, because that's very important. So typically an SME will take some time to recast his books, get the house in order before they get listed. And also there is always a worry from a promoter's perspective that once I get listed, will I get taken over by somebody? Will I, will I be, whether I will have control on my shares which I've got listed? Will I be the boss again, or somebody else will come and sit on top of me? So these kind of questions always come, and we always tell the promoters that as per SEBI guidelines today, only 25% of the minimum 25% has to be given to public, and the balance 75% the promoters can still have, which means that he is fully in control of the company. It's only 25% which is going to the public. In fact, there is one more discussion paper in public domain where SEBI has said that, can we look at if a very very big company is coming out of an IPO, and that 25% will be in some lakh crore rupees, whether we can look at a smaller number to start with, to divest, and then over a period of time they can bring it to 25%. So coming back to SME, so these and coming back to listing on an exchange, so a lot of promoters have this worry about whether they will be taken over in case in case they get listed. So many of them approach a VC or a PE, because VC or a PE doesn't generally participate in the day-to-day management of the company. They give money, but of course they sit on the board and they give a lot of guidance from time to time. And then over a period of time, they get used to this kind of a culture. Then they get prepared to get listed. But from an SME, that we don't have so much of a VC or a PE coming into a SME at this point of time. There are, but not many. So from SME perspective, it is our from SME perspective, it is very important to educate these people on why you should get listed, what are the advantages, how it's easy to raise capital from cheaper to raise capital, and how easy it's to comply. It's just that you keep doing what you're doing the best, and keep allow the reporting to be done by anybody else. So it's been a challenge, and so we are not in a tearing hurry to get keep running away with many listings in SME space, because we understand that they will take time to get listed. So we start engaging with them at the very initial stage. We work with them for about one year or 1.5 years, get them prepared to get listed, and then they come on the board. That's why we have got about 210 quality companies there as well. We always believe listing is an entry point, so whatever checks and balances you have to put, you put at the gate. But once you allow a company to get listed, then it's all they have to follow the rules and regulations which we are given. So we still have a choice at the time of entry, but once they do an entry, then we don't have a choice, because the rules are set. And last thing which I want to cover is about international listing. There is some, guidelines which has also come. People would have seen that allowing an Indian company to get listed on an international exchange directly, and then over a period of time come and get listed here. The thought about is about to get better valuations there, because the new breed companies, tech savvy companies, don't get the right valuation. The unicorns of the world doesn't get. It's a feeling that they don't get a great valuation here. So there is a proposal which is being floated also to have a guidelines to be set, wherein a company, Indian company, to go can get listed abroad and come back to India and get them listed. So these are all the lot of developments in this space. Even in the IPO space, if you see, today we get, we used to, when an IPO closes on day T, the company will eventually get listed on day T20 or something. Now it's come to T plus 5 working days. So SEBI has also worked on, a couple of measures to shorten the time for listing. As well as another important method wherein from a retail or from an investor's perspective, the money goes out of his account only when he gets an allotment, or else the money is still with his account with the a lien on that amount till the allotment gets over. So these are all a lot of measures have been put for making this IPO primary market platform more efficient, and we continue to do it. And there are some more measures being taken, that whether can we list instead of T plus 5, can we shrink it more. So there are efforts to that. So what happens is that today you apply for an IPO, tomorrow you get the shares in your demat account, and thereafter tomorrow you can start participating in the market. So there are methods. So we are working under various, because in India being such a big country, the money from investors come from tier 3, tier 4 cities also. So it takes, now that it's electronic, it's easier. Previously there used to be something called as an MICR checks. It takes about 5 to 8 days to bank that check and get that amount, and that's why the IPO used to keep pending till the funds are released. Now most of the money comes electronically. So the issuers, the merchant bankers, and the regulators with the exchanges are working very closely to see how we can get this process shortened, strengthened, and get the issuer to the market as soon as possible. Because after the issue closes till the stock gets listed, that time is kind of a blackout time when we don't know what can happen. The investor has got his allotment, he don't know when he can exit. And the companies have got the money, so it's important that immediately it gets listed. As I said, a listing is a venue where it's an exit option for people who are already there in the shares. It's an exit option for people who have participated in an IPO. When if somebody is listed pre-IPO, the shares are locked in for a period of 1 year. Just to quickly give some broad numbers on the listings. So I think the paid up capital of a company should be about 10 crores, the market capitalization of 25 crores to a main board listing. For an SME listing, the paid up capital should be less than 10 crores. For a company in the innovated growth platform, primarily into technology, IP, data analysis, at least 25% of the pre-issue capital that should be held by a qualified institutional investor for a period of about 2 years. Basic eligibility criteria for companies to get listed. In terms of main board and SME, I think 3 years of track record of companies is required in terms of existence and in terms of financials. But in terms of an innovative growth platform, no specific criteria. Preferably a Series B upward startups is required, but no specific criteria. In terms of a lock-in period, 6 months a lock-in for pre-issue shareholders for an innovative growth platform. For an IPO, it's, as I said, 1 year is the lock-in for a pre-issue platform. And there is no compulsory market making requirement for the main board and for the innovators growth platform. There's a compulsory market making for the SME platform. In terms of the main board, I think minimum you need 1,000 allottees. For an SME, it's only 50 allottees, and for an innovative growth platform also there are 50 allottees. The application minimum application value is about 1.5 lakhs for the main board, about 1 lakh for an SME, and 2 lakhs for the innovative growth platform. So these are all broad numbers which you can see in on our website. But more importantly, these are all eligibility parameters which has been put in place so that companies with some track record, companies with some financial numbers behind, promoters with track record, promoters with no disciplinary action. So these are all some of the things which we look into before we get a company listed. Track record of promoters, whether they have been declared a willful defaulter anywhere, any disciplinary actions against the company promoters, has this promoter in some other name floated a company, defaulted investors, come back and come to a different come and start a company in a different name. So these are all various due diligence the team does from time to time to ensure that we get good quality companies on the platform. These are all not a number criteria. These are all criteria which based on the performance of the company. Number criteria is always, as I told you about paid up cap, market capitalization, etc. These are all the number criteria which most of the companies, when you come to you for listing, all these number criteria will automatically be filled, because automatically they become ineligible if they don't fill the number criteria. The challenge is only on the non-number criteria, wherein we look at the various disciplinary actions, various cases pending against the company, its promoters, and then we take a call. And it's important from an IPO perspective that the risk factors is what we look at. It's not it's not necessary that every time in the list factor, the first list factor will be the company is been the company is prone to any natural calamity. So these are all understood, but more importantly the risk factor which where the company has participated in the past, some court cases, some defaults, etc. These are the big risk factors which is important to be mentioned. And that is these are the qualitative risk factors which we tell the companies, if we find out something, we please tell them, please put these as number 1, 2, 3 risk factor, don't put it as the 43rd and 44th risk factor, so that people who look at the DRHP will be able to take informed decisions based on that. So these are all some of the parameters, but end of the day, when an IPO comes, it's just by the numbers and by what people think in the market, the demand increases automatically. In the last few months, I've seen for a very first time, I've seen IPOs getting subscribed fully on day one. Most of the time IPOs get subscribed only on day 3. Day 1 and day 2 hardly 20-30% gets filled up. 70% gets filled up in day 3. But these days, a couple of IPOs I've seen got oversubscribed on day 1 itself. That's a phenomenal way to go, because that shows the confidence what people have in that company. Confidence have, because typically what happens, people will see whether the institutions are subscribing to it, and then on the last day they come and subscribe. Today a retail investor is himself coming and saying, I'm willing to go and put my neck on the block and subscribing to the IPO, which is a very good trend. So as I said, we've got many good issuers coming up in December. A lot of DRHP has been cleared. People are waiting for the festive season to get over, which got over just a couple of weeks back. So you will see some more issues in the pipeline. So these are my initial thoughts on the subject. More than happy to take questions.
Good evening, sir. Sir, there's a question which we've got on our YouTube. What is LODR regulation of SEBI?
So LODR is the listing regulations.
First order.
Yeah. So LODR, I will answer this question.
Yes, sir, the LODR regulation.
Yeah. So LODR is called the listing regulations. Previously it used to be called as listing agreement. Now it's called the listing regulations. So when a company gets listed on the exchange, they have to follow the regulations given here, the corporate governance norms, the shareholding pattern, the formats for giving the financial results. Everything is given in this.
Can I ask the same question?
Sorry?
Next question.
I can't hear you at all.
Am I audible now, sir?
Yeah.
Sir, so there's another question that has come up on YouTube. How to choose a broker? Looking at the cases such as that of Anugrah, how can investor money be protected?
So this is absolutely out of the listing regulations. But having said that, so what we do, not only as a part of the World Investor Week, we have been giving messages to people at large, the do's and don'ts of investing. So when you choose a broker, you need to see whether the broker is capitalized, whether you know the broker well, whether you and whether what is the broker offering you. So we keep saying that if somebody is offering you fixed rate of return, if somebody is telling you I'm giving you 18% return, 20% return, that's not what stockbroking is all about. Stockbroking, or a broker to choose, is to buy and sell stocks. So when you buy a stock, you get your contract note within 24 hours. In the contract note, there will be a number. If you put that number on our website, it will tell you whether the broker has bought that shares for you, at what price he has bought. That price should match with the contract note what's been given to you. So there are and there are a lot of videos which you have put on the website itself to say that what are the do's and don'ts. Don't share your online password with the broker. So choosing a broker is one, and being diligent is another. Whichever broker you choose, there are contract notes, and there are other things which the broker has to give as per the rules and bylaws of the exchange. So once you know that, and once you see that that you are bought today, and the broker has confirmed that he is bought today, you can verify that within 2 days. T+2 is of settlement now. Within 2 days, if you bought a shares, it has to come into your demat account. So if it's not coming, you can ask the broker. You can come to the investor service cell of the exchange and tell them, hey, I bought this. This is my contract note, but I've not got the shares in my account. So that's where you need to be more diligent. And that's where, over a period of time, what happens once you start trading with the broker, over a period of time, you get comfortable, and then you stop seeing your messages. In fact, suppose today if you give an instruction to your broker to buy the share, you get an SMS from NSE itself saying that your stockbroker so and so has bought so and so shares at so and so price. So you know exactly if you're bought or if you have sold. So suppose you get an SMS from NSE and that's not what you told, then immediately you can contact the broker, and if that doesn't work, you can immediately contact the exchange, and then we take it forward from there.
Sir, we have a few questions here. Sir, I need historical tick-by-tick data of commodity derivatives for my research. Could NSE help me out on this?
So commodity markets, NSE is a very new player. We've just about a year in commodity markets. So you can get tick by tick data, but that may not be very comprehensive, because we are not a very big player in the commodity market at this point of time. However, we have a company called our index company called NSE indices. So you write to them, they will be able to give you the tick by tick data. There is a price associated with that, and they will let you know.
Are exchanges or regulators concerned if the listing day returns of IPO firms are very high?
So there is always a saying that when you do an IPO, you keep some money on the table. That's what they say. So the pricing of an IPO is a very critical component which the lead managers along with the promoters take a call. But actually, answering to the question, we are not the regulators or the issuer may not be very concerned about if the company's prices go up on the day of listing, because the pricing of an issuer is a function of the decision based on the numbers of the company between the promoters and the issuer and the market conditions as a whole.
So the next question says, why does delisting happen? Why does a company raise funds to even delist?
So delisting happens for many reasons. For example, if a company, if the promoters want to wind up the business, so what they do is there are some delisting guidelines given. So what the company does, goes to the investors and say, boss, you've given me money. I have built the company. Now I want to get out of India. For example, if Cadbury says that I want to close India operations and go away, or if any company says I want to close their business, the ideal way to do is to come to the investors and tell them, this is the market value of the company. I am giving you this price, so please give me your shares back. I want to delist because I don't no more want to get listed. As I said, listing has got a lot of obligations in terms of compliance, right? So if I don't want to do that compliances, or my I've changed the business, or I'm exiting out of the business. So instead of running away with the money, I'm giving back the money to the investor, logically, legally, saying that I'm delisting from the exchanges. So please surrender your shares, take the money back.
So another question says, what safeguard checklist to be followed by the retail investors from the trap of market operators who influence the price of scrip?
So operators influencing the price of the scrip is the work of the stock exchange surveillance team. We will look at them very closely if somebody is manipulating the prices. From a retail investor perspective, what the retail investors normally do is they look at the company. If they are very informed investors, they can go and select a company, or else they can go to a mutual fund. The mutual fund will decide. The fund managers are more equipped, they will decide, and they will go and buy a company based on their research. From an individual's perspective, they will go and from a retail perspective, if they find from their own analysis and research, they find a particular company is worth the price based on the numbers. As I said, all the numbers are in public domain. Based on the numbers, if they find it's worth, they go and buy it. But in terms of people manipulating, that is the stock exchange surveillance and the SEBI surveillance team to get these guys who are trying to manipulate the prices off the book, and that they will do it on day in and day out, from in every order, every tick, that will be taken care.
Another person asks, how do they decide the IPO price band?
So that's what I said. So IPO pricing is decided by the issuer, the merchant banker, and issuer and the merchant banker. So the obviously the promoter always wants to have a higher price, right? The higher the price, the promoter, the more money he gets. From an issuer, from a merchant banker's perspective, the merchant banker has to sell the issue, because if you're going to keep a very high price for the issue, the investors will not buy it, because investor will think it's very expensive. So if you want 100 rupees for a particular share, the merchant banker thinks the right price is 90 rupees. So they will try and negotiate on the table, saying that what's the best price, looking at the numbers, looking at your company's EPS, what's the PE ratio, and what is the market conditions. One of the very important factor to be considered is the market conditions. When the market conditions, we always call this as a market sentiment. If the market sentiment is good, a little bit of premium in the pricing will go through. The market sentiment is not so good, the pricing has to be really accurate. If not, the issue will not get subscribed. So it's a very thin balance which the issuer and the merchant banker decides.
So we'll take another question where Mr. Ravi asks, how to find whether a stock is liquid or not, how to differentiate between liquid stock and illiquid stocks.
So liquidity is a function. If you go to our website and if you want to buy a stock, if you see the quotes, there is a place called get quote. If you go and put a get quote, if you put the name of your company, it will come there. So if you see volumes happening in that particular stock, and if you see the difference between the best buy price and the best sell price is not very very huge, then obviously the stock is liquid. Suppose there is no trades happening today, you see there's no trade happening, tomorrow you see no trades, day after tomorrow one trade happens. So if a company trades very infrequently, one or two trades or 10 trades in a day, then that company is an illiquid stock. So you can go to the website, see the stock, see the volume happening, see the volume for the last 1 week, 10 days. All historical data is available on the website. Based on the volume, you can definitely see whether the stock is liquid or not. It's public information.
Sir, if we could take one more question, sir.
Yeah.
So we request you to throw some light on delisting and LVB amalgamation, which happened without providing even face value to retailers.
So the LVB is the cabinet has passed yesterday, and it is under the aegis of the Reserve Bank of India. So that is a banking regulation act which comes into play there. So if a listed company which happens to be a bank, and the bank is not no more a going concern, or there is a problem in the bank, then the Reserve Bank has got every right to get it merged with somebody else, or put up a scheme of amalgamation, a kind of thing. It's the same thing happened in S Bank also. There was some scheme of amalgamation which Reserve Bank came out and put. Similarly, even LVB also, Reserve Bank of India saw the performance of the bank and saw that that was not going as per the terms and conditions, and that's why they said the best thing to do at this point of time is to get somebody into the bank, and that's what they've did. And if you see a lot of reports in the past 1 week 10 days, they've all said that it's one of the good decisions which has been taken from a benefit of the bank's perspective. As I said, delisting is one of the ways of exiting a listed from a listed space. So once you get delisted for 1 year, you what you'll do is you arrive at the price of delisting. You say that at this price, I will give all my shareholders this price. If they give the shares back, I'll give this price. That's called the delisting price. So the delisting price is a reverse book building process. Book building process is a process where you apply for the shares. Reverse book building process is the process we find out the price of delisting. Once you find out the price of delisting and the company agrees to that price, then you will surrender the shares to the company, and the company will give you that price. Suppose you don't surrender and you keep quiet, you forgot to do it or you don't want to do it, but if the delisting goes through, when I say delisting goes through, 90% of the public shareholding, if the company buys back, balance 10% or something, whatever is there, the company will give you 1 year's time. Till 1 year, if you go and approach the company directly with your shares, the company will give you the same price what they paid to others. So that is as per the delisting norms. So the idea of doing this is, even if you miss the bus, you can still go and get the same price. The idea of delisting is that the company no more want to get listed for various reasons. As I said, it may be somebody wants to exit the business, somebody wants to, one way of doing it is somebody don't want to do the business, they can give it to somebody and somebody can take over. So then there'll be a scheme of amalgamation. So that's one way of doing it. It gets amalgamated to some other company. Or the other way of doing it is the promoter says, boss, I don't want to do any more business, I don't want to get listed, so they get out of business. So that's another way of doing it. So these are two simple ways of a company getting out of being out of a listed space.
So then there's another question. Should we take
Go
it
ahead.
right now?
Go ahead.
Or should we? Okay, sir. So this will be the last question.
Yeah.
Mr. Ravi asks, can the market capitalization of the exchange be used as the proxy for defining the liquidity of that exchange?
Well, market capitalization is a good proxy. Uh, yes, but market capitalization by definition is what? Total number of listed companies. Suppose I have 1,500, 1,750 listed companies. The capital of the company multiplied by their closing prices is equal to market cap, right? Suppose the company is not traded today, I'll take yesterday's price. If it's not traded yesterday, I'll take day before yesterday's price. So the market capitalization gives you the size of the market. It doesn't give you the liquidity in the market, because out of even out of 1,750 stocks, for argument's sake, only 750 stocks trades, and even 1,000 stocks doesn't trade, but still the stocks of 1,000 stocks market cap also will be computed with the previous close or 10 days old price, and you'll get a market cap. So market capitalization will tell you the size of the market, not necessarily the liquidity. The liquidity, it can be the best source of liquidity is called the impact cost. Impact cost is the cost is the cost which is arrived at between the best buy and the best sell price. If you take the difference between the best buy and best sell at various points of time, and if you compute that, and if that's less, it shows the stock is very, very liquid. That's a way to find out liquidity. But a very simple retail person to know liquidity is to put the script and see whether it is getting traded every day. When I say traded, number of trades, if it's say 100 trades or 200 trades traded every day, that means it's reasonably okay. You will get an entry exit for a small quantity of shares. If you have a large quantity of shares, then you should see whether that quantity of shares are getting traded every day, or a percentage of that is getting traded every day. If that be the case, then if not one day, you'll be able to sell your quantity in 2 days. But if a share is not at all getting traded, and then if you want to see the liquidity, that means that stock is absolutely illiquid.
So there are quite a lot of questions coming in, sir.
Go ahead.
Sir, depending on you, it depends on you whether we should take a few other questions or
Go ahead.
we can
Go ahead.
ask them to. Sure, sir. We will. Thank you, sir. So, Ms. Rashmi asks, Cobol was acquired by Idera. Can the Cobol employees' stocks be set to nil during acquisition? Idera is a public company and Cobol was private.
Okay. So these both of them are not, I guess, an Indian company. So it all depends on the scheme of arrangement. The scheme of arrangement between one company, two listed companies means typically what happens, you get a mirror image. All shareholders of this company will get the shareholders of that company, will become shareholders of that company in a specific ratio, 1:2, 1:10, whatever is the ratio, depending on the performance of the company. But here, one company is said to be a public company, another one is a private company. So it's purely depends on the scheme of arrangement, which is between these two companies. The scheme of arrangement, if it's, say, assume these are Indian companies, then the scheme of arrangement has to go to the Companies Act. If it fulfills the norms and the scheme of arrangement allows you to get a share, you will get a share, or else it's purely depending on the arrangement between the promoters of the two companies.
Sir, and Mr. Praveen asks, are there any mentoring and guideline program on us on how can we grow our startup company?
No, we don't have specific mentoring programs for a startup at this point of time. To be frank, at the same time, when a startup and innovative growth platform, we talk to the companies and we tell them about the various requirements from time to time, but we don't have a formal mechanism for this. We don't have a formal mentoring program. Maybe the angel investors or the PE group may have something, but we as an exchange don't have it.
Thank you, sir. There are so many questions that people have in their mind. Thank you for answering all of them so patiently. And I'm sure a lot of questions could not be answered due to time constraint. I apologize for that. But thank you so much, sir, for this very well explained webinar and such a knowledgeable topic that you enlightened us about. Thank you so much, sir. And thank you to all our viewers.
Thank you very much. Thanks for this opportunity. Thank you.
Thank you, sir. Thank you so much.